Hello, this is Steve Malone with Compass FX. I hope you're doing well today and you're getting some good trades. Today I want to get back on the topic of keeping it simple. Keeping your trading simple by avoiding some of the more complex ways of trading. Sometimes these complex ways of trading, these advanced trading strategies, we think that if we don't do them, we might miss out on something. But I'm here to tell you that oftentimes some of the most basic ways of trading can yield plenty of pips in the market. You just got to be aware of those basics and remind yourself from time to time to get back to the basics. So today I want to talk about keeping it simple with placing stop loss orders. I received an email not too long ago that said, well, keeping it simple sounds good and all in trying to make pips. Well, how do you keep your trading simple when it comes to money management? Well, I think there are 5 areas where you can place a stop loss order. You can look at the previous swing high and low, look at pullback highs and lows, look at previous candle highs and lows. I also look at the dots levels and a trailing moving average. These 5 areas are where you can place stop loss orders as you trade. So in today's video, I want to walk you through these 5 types of stop loss orders that you can place and properly manage a trade. Now I'm going to start off with just this basic chart. And on this basic chart, we have some swing lows here and here, and some swing highs. Now what makes a swing low? A swing low is typically you have a low, a lower low, and then a higher low. That's a swing low. That means the market is returning to a previous high, basically more or less a retracement to reversal signal. Now typically a swing high is made up of a high, a higher high, then a lower high. This is not quite the lower high that we'd like to see, but as the market closed lower than it did previously, that is a swing high. So we're looking for those points where the market turns, and we can place a stop loss right beyond those levels. So imagine, if you will, I was going short today. This candle comes down and closes lower than the previous. I can place a stop loss right up here as I go short in this candle. So my first type of stop loss is above the swing high. Now if I was trading this long, it would be below the previous swing low. Right there I'd place it something like the swing low and then include the spread. Okay? Now let's look at another stop loss placement, and that is on pullbacks. When the market started making its move down, it pulled back right there. When it pulled back, my original stop loss is above the swing high. When the market drops and closes lower and then opens and continues going lower, I can move my stop loss from here to above the pullback. Another area to place the stop loss. Now I've basically now have a trailing stop. I've started with the swing high, and now I've come to the pullback high and I've moved my stop loss. And I'm not quite yet at the point of entry, but I've tightened up my stop. Now comes the third. As the market continues to move down and move down, you can then follow the trade by placing your stop loss at a previous candle's high or low. So as the market moves down and closes, moves down and closes, I can look at placing my stop above this candle or above that candle. So in this case, had I stayed in the trade, this pins high but doesn't take me out if my stop loss is above this candle and the market continues moving down. Typically most traders look to place that stop loss 2 to 4 candles back. You can even do that when you first start out in your trade. So let's say I started out on my trade right there. I look back 2 to 4 candles and find that high. Well, 2 candles back is this high. That's the highest high point, again being the swing high. Now let's look at a couple of other ways you could do it. For instance, look at the dots levels. Hundreds of traders around the globe are using the dots levels to identify targets and stop loss levels when they trade from session to session. So an example, here we are at the European Open last night, and the market moved up, and when the market moved up above this buy entry level here, the buy stop loss level was down below. Now this is the opportunity where you could have traded long, the market didn't work out but started falling back, and you could have possibly gotten out of this trade. You would have been taken out when the market moved back to that level. Then the market turned and started to go short. Now in this case, the stop loss level is sitting right in this area, and when the sell entry level was hit, the market never came back to that sell stop loss level, and the market continued moving through the European session, even into the US session. You can see here that at the start of the US session here, if we hadn't been in the trade just yet, our sell entry was here, the sell stop loss level above 99.04. The market moved back but did not quite hit it, and then the market rolled over and continued down to the sell target number 1 level. The market moved back up again, did not hit the sell stop loss level, came pretty close to it, bounced off the 30 moving average, testing the long-term Guppy multiple moving averages, and rolled back down, right down to the sell target number 2 level. The dots have been an excellent tool to use for those who trade intraday charts, depending upon the session that you trade. If you want to learn more about dots, go to www.compassfx.com/dots. You can learn more about the dots. You can see some trading results back to 2013. It's been an excellent tool for traders. Now, another way you can look to place a stop loss is to look at a trailing moving average. In this case, I've got 2 moving averages on this chart. This is based on the synergy model that I created back in 2005. I'm using Heikin-Ashi type bars. I call them the synergy average price bars. This is the synergy trading model that you see where I compare price and market sentiment. So looking at price and price action, you can see that price action continued to move down with these Heikin-Ashi type bars. Now the first moving average is fairly tight. This is a 5 smooth with a low setting, shifted 1 over. The other one is a 5 smooth applied to high price and shifted over. So I can start out my trade. If I entered my trade here, I can base my stop loss above this level here. So here would be an entry to start trading, and it's up here. Now as the market starts dropping away, price action starts pulling away from this lower moving average, I can then have my stop loss just trail that moving average. So I'll be just above that lower moving average, and I'll hold in, and I can capture a lot of that trade. So in a long story short, keep it simple with your stop loss order placement. First, place it beyond a swing high or swing low. Then look for any pullbacks in the marketplace. You want to again be beyond a pullback. In this case, the market pulled back and then dropped. And I find that if you draw a trend line along the higher lows or the lower highs, be a good place to tell if you have a pullback or not. Third is to look at previous candle highs or candle lows. So as the market was moving down, in this case, if the market came down to this level and my stop loss was 2 previous candle highs, when it pinned up right there, I wouldn't have been taken out. Another one is to look at your dots levels, stop loss levels, or other levels as the market moves in your favor. And another one is simply to place a moving average on the chart. Like in this case, I have a 5 smooth set to high and a 5 smooth set to low. You allow that moving average to be your trailing stop and have your stop loss just beyond that moving average from bar to bar. And eventually the market came back above into this area and stopped down in this area, and that'd been a nice trade just simply following the moving averages. Well, this is Dean Malone with Compass FX. I hope some of this information about keeping it simple with placing stop loss orders will help you in your trading. Y'all make it a great day. Get some good trades. We'll talk to you next time. Bye-bye.